You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Bitcoin, Ether, Ripple, Litecoin, and more. Cryptocurrencies and other digital assets are taking the financial world by storm. This exploding market provides everything a savvy trader needs: volatility, volume, and liquidity, provided you know how to find it. That's where we come in. Welcome to the Crypto Rundown. Each week, we'll break down the latest trading activity, trends, and developments on everything from coins to tokens, futures, and even OTC options. If it's moving the crypto markets, then you'll find it on the Crypto Rundown. The Crypto Rundown is brought to you by Acuna Capital. Known as the new wave in tech and trading, Acuna is a leading derivatives market maker in traditional asset classes. As one of the first trading firms to make markets on Bitcoin futures, Acuna is also proud to be an innovator in the cryptocurrency space. Through a collaborative flow of knowledge between developers, quants, and traders, Acuna designs and implements their own low-latency technologies, trading strategies, and mathematical models. To learn more about our rapidly growing firm, please visit acunacapital.com. Now it's time to dive into the exploding world of cryptocurrencies and digital assets. It's time for the Crypto Rundown.
All right, everybody. That music means it's time once again for the Crypto Rundown, the program here on the old Options Insider Radio Network, where we break down the sometimes impenetrable, sometimes scary, always interesting world of crypto trading, Bitcoin, but of course all the altcoins and all the other things that are going on therein. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. And so far, we're loving the feedback from this new program, getting a lot of new listeners coming in from different aspects of the financial markets and outside the options space. So it's always fun to hear your questions, your comments. If you have those, you know how to find us at Options over there on most of the major social media platforms, or of course, head on over to our live chat, which you can listen to the show live every Monday, typically around this time, 4 p.m. Central, even though it has moved a little bit. I apologize for that. But it does move around a little bit to accommodate all of our various schedules, but sometime around this time later in the day on Monday. Or, of course, get it wherever you get your finer podcasts, including iTunes, TuneIn, all those fun spots. So it's great to hear from you guys. Keep those questions, keep those suggestions coming. We always rely on audience feedback when we have a new show to help us and let the show evolve depending on what it is you guys are looking for. And joining me as my special guest co-host for today, he's a guy I've wanted to get on this program for a while, my old pal, Bill Uliveri. He is the principal over there at Cenacle Capital Management, as well as known around the space as the blockchain advisor. Bill, welcome to the Crypto Rundown, sir.
Thank you so much. I really appreciate being on the show and having a chance to chat with you again, Mark.
Well, Bill, it has been a little while since you and I were on stage together. What was it, at the Voice of Blockchain conference back in, what was that, August? It's been a while. It seems like it was more recent than that, but it's been a while. Right. So you and I have had fun opportunities a couple of times now to talk about all things crypto and blockchain, but it's been a while since you've been on the network. Why don't you go ahead and give our audience a little bit of an overview of your background in the option space, as well as what it is you do on the crypto front?
Well, I started as a market maker in the OEX pit basically in 1982 at the Chicago Board Options Exchange. And I was an independent market maker for many of those years. I did do a quick stint at the Chicago Board of Trade in the corn, soybean, and wheat option futures. The futures options around 1994 and 1995. And then left the Board of Trade back over to the CBOE, where I worked with a proprietary trading firm, a liquidity provider. We were making markets, when all the internet.com stocks in the late 90s. And I really was more of a firm trader. We were a liquidity provider quoting in around 2,000 names, and then established and assumed some risk management and compliance roles in the late, 2010 to 2012. So it's been a long journey. I pretty much stayed, financial services centric, and then started my own firm, Cenacle Capital Management, which is a state-registered investment advisory firm. So we're a state-registered firm. We're a separate account manager and have a custodial relationship with TD Ameritrade.
There you go. I'm happy to have you on the program. It's always nice to find people who kind of have feet in both worlds, in the crypto world and in the options world, because it very much speaks to the mission of this program. And the other mission of this program is, of course, to welcome on great guests from throughout the world of crypto and proceed to pick their brains. That's what we're going to do right now with our crypto hot seat segment.
Forget about cold storage. It's time to turn up the heat on thought leaders from the world of cryptocurrencies and digital assets. It's time to take their place on the Crypto Hot Seat.
All right, everybody, welcome to the Crypto Hot Seat. Like the man said, this is the portion of the show we welcome on guests, thought leaders from throughout the world of crypto, and proceed to pick their brains on a variety of different topics. And today's guest is Simon Ho. He is the CEO over there at T3 Index. Simon, welcome to the Crypto Rundown.
Thank you very much for having me. It's a pleasure.
And Simon, I know you were on not too long ago, but it was in a little bit of a different capacity and certainly maybe a different audience than for this program. So why don't you go ahead and give our audience a little bit of an overview of your background and what it is you guys do over there at T3.
Sure. So my background is I've been an options trader for about the past 25 years. It's kind of the only thing that I have ever done and the only thing I think I'll do until I stop doing stuff. I'm very passionate about this particular space. And so about 6 years ago, we started T3 Index, which is basically a business that's dedicated to the development of volatility and options-related benchmarks around the world. You're right, we spoke not that long ago, or a few months ago, because there we were talking about the launch of our so-called Spikes Index, which is a competitor to the VIX. We had to delay the launch a little because the government was shut down, which is very unfortunate. But we're looking to launch that thing in the next few weeks. So that's exciting. Feedback's been really, really good on that, and we've also been working on a number of different initiatives in this particular space, in the FX space, on equities in other markets, and also an index for volatility on the Bitcoin, which is a very exciting development for us.
Bitcoin, what is that? I'm not familiar with that product, sir. The humor sometimes takes a while to get across the pond and back, but it makes it there at the end of the day. Well, I'm glad you gave us that update because I was going to start with that, actually. Of course, the last time you were on with the folks from MIAX talking about the forthcoming Spikes product, which is indeed an alternative to VIX out there in the space. I'm glad to hear that it's still working. Obviously, one of the many unintended consequences, many unintended victims of the government shutdown are all the legions of financial products that are awaiting final approval over there at the SEC. We've heard of some number of different people in the space, Simon, that they're still waiting for the government to get its act together. Hopefully that will shake out and we'll hear a little bit more about the spikes coming in the near term. But we're here, like you mentioned, we're here to talk about a different flavor of volatility. That is Bitcoin volatility. We've chatted about it before with the guys from Acuna on this show that, Bitcoin has this perception that it's 10,000% implied volatility and it's madness and exploding through the roof. But the reality is something different. So walk us through, obviously you've been researching this, putting this methodology together. Walk us through what is this Bitcoin Volatility Index, even though I think the name is kind of self-explanatory, and how are you putting this together?
Right. So we happen to know the folks at Acuna Capital quite well. And so it was some months ago, probably about 6 months ago, that we sort of had to sit down and had a discussion about it. And at that time, there was no such index. And so we wanted to basically try and build the first one. So we have actually been calculating the index behind the scenes at this point since about October. So it's got about a four-month history. So it's hardly a very long history. The reason that we haven't really been able to do it beforehand is because, as you know, options, whilst futures are listed for the Bitcoin on at least 2 exchanges, the fact is that there are no options on those. So that it's very difficult to make a vol index without options after all. So because Akuna is in the business of making markets in Bitcoin options and Ethereum in the OTC space, well, all of a sudden we had the capability to do it because we are friendly with them, and we decided to get together to build this particular index using the data that they can provide to us. So that really opened up the door for us to be able to do this. And so we spent quite some time making sure that the methodology is appropriate, because this is a nascent and brand new product. And so therefore we have to be very mindful of how we cater for the differences that might appear relative to, say, an equity volatility index. So that's how we got to this point, and we're looking to start disseminating that in the next couple of weeks. As I said, we have a decent history for Bitcoin in particular, going back to October, but it's hardly a very long time series.
And is the methodology pretty much the same as it was with the spikes? You're kind of just slapping a new underlying in there, or are there some unique nuances? Like, for example, with the spikes, obviously you had to create that dragging effect to try to tamp down on some of the skew activity that was going on that's been circulating and causing problems for VIX for some time. Is it the same exact methodology for the Bitcoin, or did you have to make some tweaks to the formula?
No, we had to make some tweaks because some things were just not apropos for Bitcoin as they would be for something as liquid as SPY as an underlying. So, yeah, we had to be very mindful of the kinds of things that we deployed. So one of those issues is that right now the index is going to be end of day, but very shortly we're working on a way to be able to get that in real time. So the difference between the end of day and real time obviously has a big bearing on the kinds of things that you can do. So once we move to the real time, we will most certainly be able to use the same price dragging technique that we developed for spikes in this case here. Now, for those who are not familiar with the price dragging or spikes in general, we developed an algorithm that we've put into the formulation of that index, which helps to ensure that the index can be very stable even in the face of fast markets. So a practical example of that is we prioritize last trade over merely bid ask, because when markets are fast, oftentimes market makers will retract bids and offers, or typically they'll retract an offer. So what that means is you can't establish a mid. If you're using the bid and the ask and you're using the mid of those to find a mid, well, you can't do that if you don't have either of those two sides. So by prioritizing the last traded price, we ensure the index stability. And the only time we would deviate from that is if the bid went through or the offer went through that last traded price, in which case we would move it. So as far as this new index is concerned, we're going to start with daily. We're very soon going to be moving to a real-time index, and where we will be deploying it. But the other very important piece, because you mentioned about the kind of differences that we had to take into consideration. One of those things is we have used what's called a simple variance swap methodology, which is a slight deviation from how most of the volatility indices around the world are calculated. So the standard model, we use 1 over the strike squared, and have the sum of all of those premiums to work out the index. In this case, we're actually applying an equal weight to that. We think that is a far superior outcome for a number of reasons, but certainly for a product that is new, that doesn't have a very liquid underlying, it makes far more sense to do that than it does to use the traditional approach.
Yeah, you mentioned that it is a little bit of a different beast. Obviously, you're going from something like SPY options and the SPY underlying, which is about as liquid as it gets, quite frankly, in the financial market. You don't have to look far and wide to find strikes that have tight spreads, let alone prints on them. I'm assuming for your methodology, you need actual trades to go through on not just to have a bid offer spread, but have an actual print, an actual trade to try to determine the effective strikes. I believe it's somewhere around the 5-strike range on at the money. So if you have a product that's OTC primarily, like you do right now with these OTC Bitcoin options, are there a lot of leaps and bounds you have to make to try to find enough prints to really be able to construct a reliable methodology? How do you go about that, Simon?
Right. So for the end-of-day version, which we have been tracking since October, that one's not such an issue because there we just use the closing prices. So that's relatively simple. Yeah. So you hit the nail on the head. The difficult part is with an underlying market that is so illiquid, relatively speaking, and also opaque. So those two things are quite difficult when you've got those two issues to face. It's actually very difficult to, we simply cannot apply price dragging because we need more information than the market will give us. So that's one of the limiting features about this, but there's really nothing that one can do because ultimately if the market is highly illiquid and it's new and there's not much history, there's really not a lot more that you can do. So what we've done with the end of day series is, we're using the end of day marks that people have, but we cannot apply price dragging until such time as we get a reliable source of that real-time information.
Bill, I know you've been floating around the Bitcoin options and volatility spaces for some time. I'm sure you have some questions for our guest here, Simon. What do you have for him, sir?
Well, you know what I think, what keeps me up at night, and this is one of the most exciting things I think about the concept of Bitcoin volatility and Bitcoin options, and that is, when you're a liquidity provider, when you're quoting a two-sided market in puts and calls, the concept of how the skew looks, right? How do you price along those 5-point strike prices that you were talking about? So on one hand, I just wanted to ask you, how do you think on the opening bell, if and when there's an ETF or when options trade on futures, what is the skew going to look like? Like on one hand, I could see as someone who is a miner, so I've mined Ethereum, I've mined Bitcoin, I can see and make a case for this commodity type skew where skew kind of goes from the lower left-hand corner to the upper right-hand corner, a lot like corn options, because the theory is, as volatility decreases and the price of Bitcoin decreases, the worst possible trade is to own puts and own Bitcoin, just like in the SPX. Owning put spreads and buying SPX on the way down generally will just kill your P&L. Then on the other hand, I can kind of see that it might have like an equity skew, where the sell-off that we've seen, at least when it was in around 20,000 per token, at least down to the low 10,000s, I guess you could say, you could see that there would be a need for almost like an equity type skew. So Simon, my question to you is, tomorrow morning at 8:30, you have to make a two-sided market in a Bitcoin options, 5-point strike prices. What is the skew going to look like? How are you going to run your curve?
Talk about putting me on the spot. Look, that's a very, very interesting question. And so we've done some homework about the performance, because we have a history now of about 4 months, as I mentioned, with what we're calling it the BitVol Index. So we have a 4-month history, and we can actually plot that against the Bitcoin. Now, if we look from October, I think the Bitcoin was near enough to about close to 7,000 actually. Obviously, it's a lot lower than that today, and so that gives us that hopefully gives us some idea. Although it's very, very short. So the first thing that I would say to you is, from the short amount of data we have, we've analysed it, and it looks like it is going to be a very interesting product from a trading point of view. So that's the first key takeaway that I would give to you and to the listeners. I actually think this could be really interesting. It is, however, very different than VIX recently. It seems to have different modes of operation, in fact, because there are times, of course, when Bitcoin went down, that the BitVol Index went up. Now, that's obviously consistent with an equity type of framework. But if I can give you some headlines here, this is kind of the stuff that we sort of did. The correlation between Bitcoin and the Volbit Index was only mildly negative. Now, this is strongly negative between the S&P and the VIX. So that's one very big differentiator. The beta of the Volbit Index versus the Bitcoin itself was also only mildly negative. So it's approximately 0.5, whereas with VIX it's multiples, because multiples of the movement in the SPX. So those two are very different. And then the other thing that was quite interesting is that we would expect the Volbit Index to spike when BTC falls, when it tanks. But at other times, and we have seen that, and that's the last 4 months, kind of the pictures do show that. But at other times, it's a bit more spurious. The Bitcoin going up or down, small, it sort of doesn't really do a whole lot. So the relationship there is not very clear cut. So I think it's a very interesting product for people to look at, particularly in the future as we get more liquidity in the options. But for now, I think that a big move down in Bitcoin has typically had a response in terms of the volatility rising, but I would caution by just saying that the time series is too short. And also, if you think about it, in the last year, the Bitcoin has essentially gone from about 8,000 to 3,200, that sort of region, from the beginning of the year, 8,000 to the end of the year, where it was at the low. And I think that it's, you had a lot of people that were capitulating potentially, retail people who got into it. They were caught up in the mania of Bitcoin. So that may not actually be indicative. So my gut feeling is that it will start to resemble equity volatility relationship more closely than it has in the past.
That's interesting because we've seen a lot of talk about that, going into the final part of 2018. The narrative was all Bitcoin, and they would lump crypto in there. I think it's a little more dubious for crypto, but for Bitcoin in particular, they'd say, Bitcoin is uncorrelated. It's uncorrelated. It's a great asset to have in your portfolio because it's uncorrelated to all of the other big asset segments you might want to have in there. And then recently, we've started to see other data coming out kind of along the lines of what you're talking about there, Simon. I think the most recent article I saw might have been CoinDesk or Investment News, one of those two. They're saying, again, talking about VIX is actually not uncorrelated, but actually inversely correlated to the VIX, which is kind of like what you were referring to. I had the same reaction that you did, though, Simon, when I saw some of this data, that it was all very, very small sample size. They pointed to the sell-off from 6,000 to 3,000 in Bitcoin that occurred primarily over around Q4. And that same time period, of course, that 3-month period, was also accompanied by a tumultuous sell-off in the S&P and a broad spike in VIX. So they drew a lot of broad assumptions from that one particular quarter that VIX and Bitcoin are negatively correlated to each other. So I kind of had a similar thought that it seemed like that was drawing a lot of very final conclusions from a very small pocket of data. It sounds like you're on that same poll as well there, Simon.
Yes, I think you're right. I mean, it's obviously the jury's out. This is really nascent, but I think we need to be careful that we don't draw a long bow from something that is really only 4 months old. So, I agree with you entirely. This is probably surmising more than they ought to, and it could be that it's just literally happenstance or it's totally spurious. We don't know at this point. I just imagine that, we saw the Bitcoin collapse from 8,000 to 3,000, and a lot of people were capitulating, and that over the last 4 months certainly behaves more like VIX than otherwise. So it's too early to call, but my gut feeling is aligned with yours in that I think that ultimately a drop in the price of Bitcoin should have a response, which would be that volatility in the Bitcoin would rise.
Speaking of, obviously we're talking about Bitcoin volatility, and this is a hot area right now, and you're not the first guys to be jumping over that hurdle there. We just saw a couple of weeks ago, it was LedgerX announcing. You guys are a little bit more staid in your descriptions of it. They're not mincing any words. They're effectively saying we've created a Bitcoin VIX. They're even calling it the Bitcoin Fear Index, which I think it's kind of interesting. Maybe the Cboe legal team may have some questions about that. But LedgerX announcing it a few weeks ago. It's called LXVX, and they're making no bones about it. They're going right after the VIX audience, but for Bitcoin. I'm curious, for people out there listening to this, Simon, they're obviously going to try to compare and contrast your upcoming offering with what LedgerX is already offering out there with LXVX. Do you have any thoughts on that product and maybe how yours compares and contrasts to it?
Yeah, well, that's certainly something that anybody who's interested in the space should be looking at. So if you look at the website, there's not a whole lot of information that is up there. So it's hard. I mean, I can't say for sure because they haven't put their methodology out there. We will put our methodology out there. In fact, you already have an advanced copy of it. So you know the entire formulation as to how we do it. I guess looking at it, they talk about a non-arbitrage vol surface. And so the only thing that I guess that we have thought that could mean is that that the approach, if it is as we think it is, and as I said, there's no way for me to definitively know that right now, the negative of such an approach is that it is model dependent and parametric. So it's also very sensitive to data quality. So those are three things that we didn't want to have in ours. So ours is not model dependent or parametric, and also, part of the things that we do to cater for volatility is to make it robust. And so by definition, we don't want it to be super sensitive to the quality of the data. So there are definitely, at least seemingly, to be some fairly big differences between the two approaches that you're talking about. But only time will tell, I guess, as to which one is actually better. But we've spent a lot of time on a number of different indices rather than just this one in sort of developing systems that will ensure the durability and the accuracy of the thing. So we're very confident that our approach is suitable for the kind of data quality that we're dealing with.
Hey, Simon, I'm glad that this segment is called the Crypto Hot Seat, because I do want to throw one at you here, and that is, we've kind of automatically assumed that Bitcoin and the Volatility Index is the new asset class, right? I mean, Bitcoin is a uncorrelated asset class, but we've somehow automatically looked toward equities because that's in our Rolodex, that's our bailiwick. I mean, we're all equity option traders. But Satoshi Nakamoto, his first white paper on Bitcoin, it was described as a peer-to-peer electronic cash system. Have you or your team ever looked at the volatility or the how things correlate with, say, for example, foreign currencies, like other ETFs, like the Invesco foreign currency ETFs? Have you given any thought to just looking at that as an uncorrelated asset class, so to speak, and comparing currency movement with Bitcoin?
That's a very good question. So we certainly have, over the years, we've delved deeply into the relationship that FX has and its impact on the volatility of those FX pairs. So it is far more, it's a distribution that is far flatter than you would find for something like the VIX. I mean, that's very obvious and it's outrageous. It's like, if the equity market falls, you can very much rely on the VIX spiking. In FX, it's far more even than that. So I guess I'm not so sure. So I'm not so sure that there's a huge comparison, frankly, between currency and Bitcoin. I would liken Bitcoin more to something like gold, because they're both considered to be this store of value, and the purpose for it is that you can hide this thing away and it can be on the blockchain and it's secure from stuff. So I suppose my hunch is that this is more appropriate to something like a hard commodity than it would be an FX thing. But no, I haven't tested between the Bitcoin and FX in great enough detail. It's more so that we've looked at FX independently, and that certainly doesn't behave like the VIX. It's far more evenly keeled.
Well, Simon, we could obviously talk Bitcoin volatility for many, many hours, but we have to keep rolling with the rest of the show. But before we do that, and I think we'll have some listener questions for you at the end there, Simon, so stay tuned. You get a little bit of a break now. But before we go on to our next segment, listeners are interested in learning more about your upcoming Bitcoin Volatility Index, of the methodology, maybe when they can expect it. Where should they go, Simon? What should they do?
So we'll have that paper up on our website in the next week. It's already done, so in fact, probably within the week. It's on T3Index.com. You'll be able to find it. I was going to say the index will be published via Reuters and Bloomberg in the coming few weeks.
Also, they'll be able to get their hands on the data at least very soon, which is great. That'll allow people to really sink their teeth into it. And then if they want to learn more about the methodology and how it differs or maybe is similar from Spike's T3Index.com is the place to go. Meanwhile, we have to keep on going right on into the Bitcoin breakdown.
It's time to explore the latest trading activity, trends, and developments across the world's leading crypto market. It's time for the Bitcoin Breakdown.
Well, Bill, another weekend, another interesting, tumultuous, volatile period for Bitcoin, most of it being reflected in the downside, unfortunately, for all the Bitcoin bulls out there coming off the weekend. Coming off last week's show, actually, I had a great chat with Tony Saliba about the institutional market for crypto and what's out there. I encourage you listeners, if you missed it, to check it out. You can get it, of course, wherever you're subscribed to this or our website, wherever you'd like to go to search for the Crypto Rundown. You can find it, of course. But it was interesting. We had a conversation last week about how it seemed like a lot of the narrative was coming in that Bitcoin was indeed a little bit range bound, maybe bounded by about, let's say, 37.5 on the upside and somewhere around, 3,500 or somewhere to the downside. Unfortunately, it seems like we've broken out of that as we're speaking right now. We're well south of the 3,500 level coming into showtime, right around 3,417 out there in the old Bitcoin. It was off 4% for a while. They're only off about 3.3% right now. We're seeing similar sell-offs across the board in most of the major other coins as well. ETH off nearly 8%, 103. We're seeing Litecoin off 6.25% to about 30, 31, and even good old XRP south of that mythical, magical 30 level off to about 28.8 right now, off about 5.5% out there. We'll get to those in a little bit if we have time for the old altcoin universes. Don't want the altcoin folks getting mad at me. We like to talk about those too. It's just not all enough time in the day sometimes. But yeah, it seems like we have indeed broke out of that range to the downside, which will unfortunately disappoint a lot of the Bitcoin and crypto bulls out there. Also, as a result of the sell-off, we're seeing market cap coming in. It dropped about 7.5 or so, 8 billion roughly on the weekend. On Friday, it was a little north of 120. Coming in, it was about 112.5 or so billion coming in. And Bill, it seems like this sell-off was kind of a bit of a 1-2 punch, starting with the folks over there at Morgan, kind of talking down the institutional side of crypto, which again is interesting. I'd encourage you to check out that conversation I had with Tony, who's kind of knee-deep in that institutional crypto space right now. He has some interesting, I think, rebuttals to that argument. But all that kind of doom and gloom from a big institutional player like JP Morgan spooked a lot of people in the cryptocurrency space, and that seems to have driven a lot of this downside. We're also, of course, seeing they were talking about the next support level over there being around 2,400, which is certainly about $1,000 away from where we are right now. And then, of course, Bill, on the heels of that, now today we've seen a lot of news coming out of NVDA, who many people viewed as a bit of the canary in the coal mine when it came to crypto demand and Bitcoin demand and all the need for the gaming rigs to mine and all that fun stuff. NVIDIA kind of pre-announcing their earnings, which is usually never a good sign, missing by 14 billion. People are lumping this into the crypto category. I'm not sure if it really belongs there, but I'd be curious to get your thoughts on this as well, Bill. But we're seeing it off about 14% intraday here towards the close again today. Again, rightly or wrongly, this is getting blamed on crypto as well. So a lot to take in on the start to the week here, Bill, as well as all of last week. Let's start off with what's been catching your eye of late on the Bitcoin front from a trading and maybe a mining perspective. And then if you have any thoughts on the dual 1-2 punch of Morgan kind of undercutting crypto as well as the NVIDIA earnings, have at it, sir.
Okay, well, here you go. You asked for it. I'm going to give it to you. So anybody who owns cryptocurrency, anybody who owns a Bitcoin, it is influenced by what JP Morgan says, doesn't deserve to hold the token, because most of the people are very libertarian bent. I mean, the reason why we own Bitcoin is because of the banking situation and the central bank, Federal Reserve, quantitative easing, et cetera, et cetera. So I don't even look at what they say. And remember, Mark, when you and I were on a trading floor, if I was standing next to you, if I would say, hey, Mark, are you long or are you short? You would tell me the opposite of what you were doing. If I said you were making money or losing money, you'd say, oh, man, I haven't made money in months. You would never say that you were doing well because it might bring competition into otherwise we're double wide or triple wide markets. So you have to take with a grain of salt anybody from the institutional side, I think, who speaks about or opines about Bitcoin and adoption or the price. So that's number one. Number two, we used to joke around on the trading floor saying that if you only lost half your money every single day, you'd never go broke. And that's kind of like how some of these altcoins are. These altcoins are down 98%, 97%. They saw ridiculous prices back in the summer last year. And now, they've gotten really their clock cleaned. And so again, if you're in it because of what other institutions are doing, then you're in it for the wrong reasons. Most people that I know that own cryptocurrency, they hold it because of it resonates with the philosophical nature of the distributed network, distributed computing, distributed ownership of assets, and removal of the third-party intermediary. That's why they own Bitcoin. But then get back to the NVIDIA side, all right, and I'll talk a little bit about that. So one thing that we did back in the summer of 2016 is we created what I would call a blockchain enterprise investment strategy. So it's about 30 companies that have publicly stated that they see blockchain technology as an amazing, form of technology, and they are directing attention and assets and resources to learn more about it and how it affects their business. So as a state registered investment advisor, we wanted to stay as far away from cryptocurrency as we possibly could. So we felt that maybe just like a Fidelity sector fund, there might be an interesting way of managing assets in U.S. listed companies that are embracing blockchain. And so actually in the fall of 2018, we kicked out AMD and NVIDIA out of our portfolio and put in a few other companies because on the mining side, we could see that we were beginning to lose money. So there is a direct correlation between the cost of electricity, the difficulty of a cryptocurrency token, the equipment that you need to mine the cryptocurrency. And so this gives us like a return on investment type of view of how the miners are doing and how the GPU companies are doing. So, we kind of saw this coming a little bit, even though it's interesting that NVIDIA really discounted and downplayed their sales of GPU cards from miners. They didn't really want that to be part of their business. So I find it interesting that they're concerned about that. But I would say from a mining standpoint, we're only now beginning to see a little turn in the profitability of mining, and because difficulty has dropped about 35 or 40% in the last 6 or 7 months.
I was thinking the same thing, and I want to get more of your thoughts on mining in a bit. I think we have some listener questions to that effect, so we'll save the talk for mining, even though that's one of the reasons why I wanted to have you on. I know you're knee-deep in that world. But I was of the same opinion. I thought NVIDIA kind of separated out the crypto segment a while ago and made their announcement on that. So that's why I was so surprised to see everyone running with this story that this is a crypto-driven sell-off in NVIDIA, which it seems like they're taking the same real excuse that everyone else is out there, slowing global demand, slowing demand for these chips, and that's causing the problem rather than some sort of implosion in the crypto space. Is that your take as well there, Bill?
Yeah, absolutely. I mean, we're always looking for why things happen rather than focusing on the fact that it is happening, right? We're always looking for a daily excuse or a daily reason why the market is up or market is down. And clearly, the true generic answer, it's all about supply and demand. It doesn't matter whether it's NVIDIA cards. Look at the FANG stocks, Mark. I mean, thank God those things pulled back. I mean, 6 months ago, we were all saying, how much higher can Facebook and Apple and Amazon go? How much higher is the PE ratio of Berkshire Hathaway's that owns so much Apple going to go? I mean, Berkshire Hathaway's is like a technology company. And here, we have the opinion that Warren Buffett is more of a value play guy. So I think that, NVIDIA and a lot of these tech companies pulled back for the very same reason that we saw the FANG stocks pull back in the fall of last year. So I don't really see this so much as a cryptocurrency play per se, although I think some of that is. It's like maybe NVIDIA was afraid to embrace cryptocurrency as a reason for their sales because, every time a miner builds a mining rig, he's got to buy, 6 cards for every mining machine, where if you're a gamer, you're going to buy 1 over the course of a year. So, I think it was one of those things they were afraid to admit added to the bottom line. So I think we're going to see, until the GPU cards get around $80 to $150, I think, on a regular basis, you're not going to see the prices of cryptocurrency miners go into that space and start building rigs again.
Yeah, that always seemed like a weird bubble to me when people were fighting on the secondary market for these bundles of 6 super high-end graphics cards. You knew that could only last for a certain amount of time, and it seems like the folks at NVIDIA did as well. Of course, all this tumult in the space is translating into some decent volume out there, and one of the main listed products out there right now, the futures over there on CME, which are continuing to sell off as we speak. They're at about 33.75, off about 130 handles in that front Feb contract. We're seeing decent paper out there today, about 4,500 contracts, not quite the 7,000+ we were seeing last week. So maybe some of this additional sell-off is people are getting a little bit, I wouldn't say inured to it, but maybe it's not quite as terrifying as it was, even though we did break through the lower range, that 3,500 level, which I know a lot of people were watching. And of course, the Jan contract went off the boards recently as well, so we'll see how Feb, if that can keep a pace with what we were seeing out there. But overall, it's been a fairly robust story for the CME futures out there. The other side of the coin, the SIBO listed futures, kind of an interesting story there as well. In particular, they're probably also contributing to a little bit of this sell-off right now. They announced last week that they're going to, or they did, I should say, pull their own request to launch a new Bitcoin ETF. We know they, of course, partnered with Gemini and the Winklevoss twins to create their own version, the OneCoin version of the Bitcoin future. We've seen, and it's been kind of a surprising development for a lot of us out there, we've seen that the 5-coin CME contract has really kind of run away with it, even though a lot of people thought the OneCoin contract, particularly when Bitcoin was floating around 18 to 20,000, would certainly be a lot more palatable, particularly to the large retail audience out there. Yet the the response has been anything but out there. People want the larger coin. I'm sure the sell-off has driven some of that, but still an interesting conversation. We chatted about that before on the show. Go check out episode 1 if you want a little bit more of a deeper dive into that. But last Wednesday, they pulled their application for what would be, at this point at least, the first ever Bitcoin ETF. The big question, if it's approved, the SEC has already knocked down a few of those in the past, including applications last summer from the Winklevoss twins themselves for their own version coming out of Gemini. They didn't like what they were talking about. SIBO taking their own tilt at the windmill now and now pulling it back for similar reasons to what Simon was just alluding to earlier at the top of the show with approval for his new product. The SEC is not approving anything right now because our government was shut down. We have this temporary deal in place, so maybe that'll speed things along a little bit, but you never know. Sure, there's a big backlog there they have to get to, and with these sort of temporary funding, I don't know if all of that will be covered. The SEC was going to approve this, or at least review this application before. They were hoping VanEck and looks like SolidX Partners were hoping to be the first to list this fund. You know, Bill, we've heard this for a while. I'd be curious your thoughts on this as well. Everyone's kind of been saying for a while now, it's an ETF. It's an ETF. That's going to be the catalyst that rejiggers and really reboots and adds a little bit more life to the crypto and ETF space. We saw that happen, of course, in the volatility space. That really gave VIX a lot of lift when we saw a lot of ETPs coming online to drive flow in the futures and indeed the options. Are you of that same thought as well? We're kind of waiting for the ETF to get to that next tier, or do you think it's a lot of much ado about nothing, and the market can really build and grow volume without an ETF in the near term?
No, Mark, I think we need the ETF, and I think the ETF is coming, and maybe it doesn't come at the same speed or rate that we would like. But the truth is, for the average retail investor, the average person who's going to buy and sell Bitcoin, it's still a very difficult thing to do. Downloading a wallet, getting the AML KYC clearance from the compliance department to make sure that you are who you say you are, and let's be honest, I'm sure for the people that are listening to this show, and maybe you can answer this, like what percentage of people are trading covered call writing strategies or trading ETFs in their self-directed 401k or their self-directed IRA? I mean, I think there's so much money in the space that if they could go through TD or Fidelity or Schwab, they would be really throwing a lot of money at this asset class. And really, what we're seeing, if you read Cranes, one company, the Athena Bitcoin people here in Chicago, across from the Merchandise Mart, Athena Bitcoin has about 100 ATM machines located in the United States. They have maybe 30 more in South America. And South America is embracing blockchain, it's embracing Bitcoin specifically. So we're actually seeing maybe a quiet adoption of the accumulation of Bitcoin, but it's not happening through our 401k or IRA or our trading account. It's happening through ATM machines that are being provided by Chicago-centric companies, which I think is super exciting. So again, the ETF will come. It's just a matter of time. And I think when it does, boy, it's like Katie bar the door. You're going to see a lot of activity and a lot of trading in that space.
Yeah, that will be a great moment. You mentioned TD and others. They're kind of getting on that train while they're waiting for the rest of the industry to get its act in gear. They, of course, announced a big stake in, I believe it was LXVX. Those guys were on our network not too long ago talking about that. In fact, I believe the CEO of TD was actually quoted in the release. So they're clearly putting their money where their mouth is and trying to get behind the crypto wave because they're clearly hearing from their audience that they want that. So it's interesting to see the big money. Of course, Fidelity announced as well that they're on board with the crypto space in a big way. So we starting to see the traditional players in the financial space make their cautious inroads into crypto. And you're right, Bill, once we start seeing all these pieces come together, and certainly when an ETF, when and if that does come to pass, that will maybe be the final link in the chain that'll keep things rolling along and get that volume really cranking. Speaking of rolling along, we have to keep rolling. You guys have a ton of questions. You hit us up all the time. We try to feature as many as we can. So let's get to it with some of your crypto questions.
You've got questions about crypto. Who doesn't? It's time to find out the answers to your crypto questions.
All right, everybody, welcome to the Crypto Questions segment. This is, of course, the portion of the show where you guys take the reins with your questions. Simon, hope you enjoyed your little respite there. I'm putting you back on the hot seat now. Actually, Samantha is. Don't blame me. This question is from Samantha Lee. She's kind of referring back to the discussion we had at the top of the show, but let's put it out there one more time definitively, once and for all. So that's why it's the hot seat, Simon. I'm putting you on the hot seat. You're going to have to say once and for all the answer to Samantha's question. She says, what's the truth about Bitcoin? Is it a correlated or an uncorrelated asset? Does that association, and the second part of that, which is also interesting, which we didn't touch on earlier, is does that association hold true for most of the crypto space? So let's reiterate what we talked about earlier, Simon. Give your final answer, yay or nay, for that first part. Then we can get into that second part, which is a little bit more interesting as well.
Okay, so correlated to what?
That's what she's saying. Is it correlated to anything? She's heard that it's uncorrelated. So it sounds like, and we were talking about it earlier, you think it's more correlated to pure equity volatility. So is that your official definitive statement on the subject, sir?
Well, I actually think my point was more that the volatility of Bitcoin is correlated to VIX. So that's more of what I'm thinking. As for whether or not Bitcoin is correlated to something else, I'm much less qualified to answer. I think that the time series is too short to make it a definitive conclusion on that. And I think that the reasons that the Bitcoin has fallen are reasons that belong specifically to Bitcoin as opposed to anything else. So I suppose what I'm saying there, then I guess, is that it's not correlated. For now, it isn't. It's moving on its own dynamics.
There you go. Interesting stuff there. You know, that kind of speaks to the broad nature of the space. Speaking of the broad nature of the space, I think our second part of her question is kind of interesting because we've seen this before. People lumping in all of crypto with Bitcoin. Oh, Bitcoin, where Bitcoin goes, all of crypto, all the altcoin must follow. That's a little bit of a false assumption. You know, people think Bitcoin certainly leads the dance. It's the largest market cap. It's the most trading volume, somewhere around 2/3 to 3/4, even 80% on given days. So it certainly leads the dance. But all these other coins and tokens, they are all created to serve different needs and different purposes. And so you can't really assume that because Bitcoin maybe is uncorrelated to this or is somewhat inversely correlated to that the same association holds true for Ethereum or Litecoin or any of the other 1,000+ cryptos and altcoins that are floating around out there. Do you hear this a lot as well, Simon? People are kind of making the same general assumption that what holds true from a correlation or maybe just from a general standpoint when it comes to Bitcoin also holds true for the rest of the crypto market. I guess that would probably be great for you, Simon, because then your work to do a pure altcoin volatility index would be very easy.
Yes, it would. I think one of the things that many of obviously in the crypto space, it's dominated by the top, say, 5 or 6 coins, and so anything below that is really it's essentially nothing more than noise. So I hear you. If they're all nicely correlated, they'd be really good to make a macro sort of volatility index off of that. You could still do it anyway, but so I guess it's a difficult question. I think that people are going to lump them together, and that's partly because when Bitcoin in particular was collapsing over the past year, I think a lot of people were getting out of anything that they could. So it was more like that the rising tide was floating all the boats type scenario rather than there being sort of differentiation. It was just wholesale selling of all of the cryptocurrencies. I am more along the lines of you. I think that ultimately, though, if these things can mature and they start to develop greater open interest and more interest from the community in general, I think you will find that they will differentiate themselves, much like currencies do.
All right, Bill, these next couple are right up your alley. I'm going to lump them together because they're kind of related questions. First off, we have a question from Jay Lev. He or she wants to know, is it still worth it to mine Bitcoin right now, or are the power costs not covered by the lower price? You kind of alluded to this a little bit earlier, but I'd like to get I'll put you in the same hot seat I put Simon on for the definitive statements. And then the second question, kind of related, comes in from Dan Pemberton. He wants to know, he says, Bitcoin gets all the ink, but can you talk about the mining and trading experience for other popular coins like ETH, XRP, and Litecoin? You mentioned you have mined some ETH, so I'd be curious, Bill, to get your thoughts on both of these. First, in general, the value prospect of mining Bitcoin itself, and then talk about the experience of some of the other coins you've had experience mining.
Okay. Well, I would say that right now, so if you live in Illinois, your residential electric rates are approximately 5.5 to 6.5 cents per kilowatt hour. And if you owned one Bitmain S9 Antminer to mine Bitcoin or Bitcoin Cash or some of the other same algorithm type coins like Digibyte or Litecoin Cash, something like that, you can expect to pay about $1.50 a day per machine just in electricity. That doesn't include your internet connection. So right now it's unprofitable, I would say, to mine Bitcoin. If you could figure out a way of getting electricity for about 2 or 2.5 cents per kilowatt hour, you would make a very small amount of money mining Bitcoin. So right now we're kind of at this crossroads where the price of Bitcoin has dropped, the mining difficulty has dropped. Miners are watching with bated breath to see the pendulum swing the other way, where the difficulty kind of stays low and pumps back up again. But right now, unless you're stealing electricity from your neighbor, it's an unprofitable financial endeavor. But then again, people who are mining Bitcoin are willing to maybe take a little loss in it just in order to establish a position in the tokens. But again, it's not in the United States, unless you have very, very low electric costs, it's not financially a good proposition right now. And that's the same with Ethereum or Ethereum Classic and any of the other tokens that you can mine using GPU equipment.
Separate from the cost, maybe I think he wants to know also a little bit about the experience. Is one more complicated or less complicated to mine, and maybe any other anecdotal wisdom you could pass along, Bill? Now's the time.
Well, listen, you're talking to a guy that is a ham radio operator. I'm a total geek. I used to strap CB radio antennas on my bicycle and go riding around the neighborhood trying to have conversations with people. So in terms of the technology, I think I'm crazy about it, and I wish I could spend more time, looking at it. But I would say that the experience has been fun. I'm the type of person that really can't learn things intellectually, like by reading. I have to actually do it. So by doing it, I think it's given me a great perspective on the obstacles and the positive attributes of cryptocurrency and the transfer of value from one person to another almost instantaneously for virtually no cost and without the need of a middleman. I've given 2-hour continuing education classes to the Illinois CPA Society, Financial Executives International, a lot of CEO and CFOs, because again, this is a new technology and we're kind of stuck in an old world. So for me, mining Bitcoin, if you buy a Bitcoin machine like the kind of rectangular shaped shoebox looking devices, really it's really easy. You power it up, you log in through a web interface, you insert the mining pool address and a Bitcoin address, and that's it. You can pretty much set it and forget it. Some of the other GPU graphics, the graphic card mining, that requires a little bit more interest and more time, more energy, because every single token has a quirky kind of algorithm or a quirky way that you have to set up this string of instructions in order to receive and participate in the pool. So I encourage it. Like anybody. You have people who love, Android because they can play around with it, or you like Apple products because you don't have to touch it. There's some people I know like Linux-based machines because you can have so much power and so many options. And then there's people that like, just the Windows-based machines and they don't have to touch anything. So if you're a do-it-yourselfer, if you're a guy that likes to tinker around, then I would highly recommend it just for the experience as a hobby. Just build one or get one machine and play around with it.
All right, everybody, that music means, unfortunately, we have come to the end. It's amazing how fast an hour flies by when you're talking all things crypto. But before we go, I'll go back around the horn. Thank both my guests here, my guest in the hot seat, who did admirably, as well as my guest in the co-host seat. We'll have to see about wrangling both of them back on, especially when they have more info on their respective products. But Simon, we'll start with you. Again, that website, T3Index.com, is the place to go for more information. And you're expecting to have more data and white paper available in the coming weeks, Simon?
Yes, that's right. Within a week, we'll have all of that uploaded to the website.
Within a week, even better. So I'm glad you can make it on, Simon. You did a great job on the hot seat, so feather in your cap, sir. And we'll have you on again when we have more products listed and we have more insights, and hopefully when these approvals are done, right? So we could actually sink our teeth into the actual product itself. But good luck on the approval process, Simon. We'll look forward to having you back on soon when we could see the product out there in the ether, pun intended, for ourselves. And Bill, you mentioned kind of some of your continuing education, some of your mining activities, your money management. If people want to go out and learn more about what it is you're doing, either on the general money management front or maybe more specifically to the nature of this audience on the crypto and mining front, where should they go? What should they do, Bill?
Well, they can visit our website at www.cenaclecapital.com. Cenaclecapital.com. I'm also, post things on Twitter and LinkedIn quite frequently. But again, if they're interested in looking more at the safe, quote unquote, safe side of companies that are going to be monetizing blockchain, that might be a conversation I would love to have with somebody. But the cryptocurrency mining is more of a hobby, and it just keeps me in the space and gives me, a few alerts as to which way things are going. So, we're still registered and, got to follow the compliance issues. So that's just something I do, personally.
Check out what Bill and his team have to offer over there at Cenacle Capital Management. That's CENACLE. Give him a follow while you're at it over there on Twitter, just at Cenacle Capital. He tweets out a lot of great data on all these different areas, including if you like just basic covered call data and things like that. That's right up Bill's alley there. So check it out at Cenacle Capital on Twitter and the major social media platforms to learn more. And on behalf of Simon and Bill, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, of course, for sending in such great questions. Keep them coming. Maybe we'll have to have an all-question show coming up because you guys have certainly been bombarding us. We love to see that. And we'll see you back here next week for more of the Crypto Rundown.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.